moment to introduce our guest for today. Although sir doesn't need any introduction, a very popular face. But again, Nooresh sir has been an active blogger for over 17 plus years, and that has been like a great contribution to everyone around. We are really benefiting from that. He's an educator and also a SEBI registered research analyst. So his forte is he tried to pick turnaround stories and breakouts in Nifty and try to find out sectoral leadership using his Techno Funda techniques with a major focus on mid cap and small cap space. So in today's session, we'll be discussing like how it all like started for him, his journey, and how like at this point in time he's using a combination of technicals and fundamentals to our advantage. And yeah, so and in the meantime, like initially I'll be asking few questions, and after that we will be taking questions from our audience as well. So please feel free to send in a speaker request, or you can simply type in your questions in the comments. So a very warm welcome, sir. Any opening notes?
So nothing much. This is say another way of connecting with people. So I've been writing, and now talking also has become a good part of it.
Great, sir. So, sir, tell our attendees like how it all started for you, and during your journey, you might have experienced various phases, right? And over a period of time, we form one process, right? So today, if we talk about like you use the combination of technicals and fundamentals. So initially, was it like same or like how it graduated for you?
I'll not go very detailed, but I started tracking markets in 2004. The first event was 17th May 2004, which was Black Monday. Got a lower circuit. That is the time we realized I was listening to a conversation with my mama and his friend, Mr. N.S. Vidai, about how just before this period they were discussing whoever wins the election, the markets are to go down only. And then we see a lower circuit. So that's how the curiosity started. The next turning point in terms of looking at fundamentals started after 2008. So 2007, I turned full time in January. And that was 1 year where everything worked. You could have touched anything and the stock would do well. So all the companies which I actually made money in 2007, 8 and sold on the way down purely on technicals because prices started falling and breakdown started happening. So I had a few multi-baggers in a few names, and say 8 out of 10 stocks, or maybe the five multi-baggers I had, four of them delisted over the next few years. And that is when I started looking into fundamentals, meeting investors over the years. So that is the time I started meeting a lot of investors, and over the last say 13, 14 years, I've been meeting a lot of investors from 2009 and reading about everything on various forums on fundamentals. So the process today is look at fundamentally good ideas from friends who do a lot of work, make a list, and buy them on technical reasons.
Right. So if I were to ask her, like initially when you started, so fundamental was given more weightage, or it's like you started
And
with technicals and so as to like filter out the companies you use fundamentals.
so I started with technicals. I am still a core technical analyst per se, and use a so see in the end, Techno Funda implies you have to be good at one side of it. You cannot be 50-50. That would mean you will screw up on both the sides. So I'm essentially a 80% techie and who does 20% of fundamentals to look at companies in terms of what are interesting. And one of the major things which helps me is something of my hobby, which is looking into all chore companies. So that allows me to actually weed out the worst names. So I'm the one who made a tagline "Chore Bane More," which is where I look at companies changing governance. But in that process, you learn about all the companies which are terrible. So that reduces one part of Techno Funda wherein you are able to avoid the worst right away. And the rest of the universe you traded on technical. So initially a technical analyst, still a core technical analyst who uses a lot of fundamentals.
Great, thanks. So when it comes to technicals, like there are a number of pointers or maybe things which we can look for. So what exactly and in your analysis, technical analysis, you focus on?
So it's mainly price and volumes, chart patterns, and looking at structural trends and sectoral trends. So relative strength is one of the studies which I started doing over the last 10 years in a major way. So we use mix of price action, volumes, and relative strength. Not looking into indicators at all. So indicators is out of the picture. It's only for indices. So in terms of stocks, we try to look at price chart patterns, then various other things on technicals, but indicators are not a part of the process in terms of stocks.
Right. And obviously indicators are not a part of it, but again, when it comes to technicals, so we have various phases. Like one is the accumulation, and then stage two, three, four follows. So is it like you identify the trends early and become a part of accumulation phase, or it's like in the second stage you enter and ride the momentum, and when you're charts give a signal of exit, you exit your positions. How exactly it goes for you, sir?
So see, once you start doing technicals for a long period of time, you want to be in the process of trying to preempt trends, right? So if you try to wait for a lot of confirmations, you lose out the first 20% of the move. But if you can get in before, so take an example of say June 2022, a note we came out on banks, which is where the banks were at the same price before COVID and post COVID also when the whole thing was over. So there were multiple technical reasons where you could preempt the trend, taking a bet if the things have to turn from here, this is the place, and then you get confirmation. So what you want to do in technicals is make a thesis in terms of what is the probability of this sector doing well, and then you start looking for confirmations and try looking at various stocks in the sector, related sectors. That allows you to preempt a lot of trends, and that is where a lot of say when the confirmations come, you're able to actually add up more quantities and be more confident in your trade, wherein you can allocate a lot more. So our process is keep tracking everything and make a thesis of what you want to do. And once the market also starts confirming that, just put your neck on the line, put your body on the line, and just play it out.
So when you identify, say, any particular sector, so you prefer the basket approach, or you go company specific, or maybe the sector leaders? How exactly is the process at your end?
So here I'll talk about how I started becoming more and more basket approach. What essentially happens is when you pick up a sector, so back in 2012, 13, and then in 2014, 15, looked at into textiles, chemicals. So I remember in textiles, I had a good bet across the larger names. I had a very small bet on Indocount, which I sold off at a 50% return. That stock ended up being a 20x in that cycle. So from that point of time, I started increasing more weights on the basket side rather than being, say, for example, textiles would be 30% of the portfolio. It would generally happen that 25% of the stocks are in the first two names itself. But over a period of time, over cycles, I've realized the worst of the basket actually does the maximum return. So in the pharma return rally, you'll suddenly see a Marksans Pharma go up 25 times, right? And Endocount going up 20 times. The whole point is you take a basket wherein a large part of the basket is in the leadership names, but you have very small 1 or 2% allocations into the worst names. Those going up 5x, 10x, 20x could actually change the whole return. So started approaching more basket approach, but again, the large part is still the leaders and the ones which are showing the real trend. And you have a small allocation to the worst names.
Right, sir. So people generally, I mean, talk about or fascinated by the term multi-bagger, right? But again, it is the overall portfolio return which matters, right? So what's your view on this? Then how it had evolved uh, for you? Because when it comes to technicals, I think you ride the momentum and play a concentrated bet and make a good return instead of waiting for multiplying the investment x number of times, right?
So there is this one major say myth which is a belief that technicals is only extremely short term oriented. But the fact is, technicals or any sort of analysis you look at, you're looking at the markets from a different spectrum. So you can look at a long term time frame. A very simple example is a company like Reliance Industries, which everyone knows, right? It gave a multi-year breakout in 2017 after 10 years. Now, if it's a breakout for 10 years, you can hold it for 1 to 2 years of the breakout, right? And over the next 2 years, that was the stock which did the best performing returns in the markets, irrespective of the markets. Same way, Hindustan Unilever breaks out after 12 years from 2002 to 2012. It does really well for the next few years. Same way, Indian Hotels breaks out last year, goes up 100%, right? So the whole point is, if you find major trends, you need to be able to digest 20%, 25% downswings in that trend. You can't expect a stock to go from 100 to 500 without a 20% fall, 25% fall in the interim. So the fact is, technicals. So there is a statement by Rakesh Jhunjhunwala in one of his older interviews where he actually says technicals allows him to hold. And what are we all doing? Technicals is making us sell too early, wherein we are always trying to look at exit strategies on the way down. But the fact is, if you get one trend right, it can change everything. Because if you get a say a sector right, it goes up 60, 80% in that year. You have an alpha return which could take care of the next couple of years. So trading out longer term trends via technicals is something which most people don't focus on, and this is where we try to focus a lot more on.
Quite interesting. So in between, we have two speakers. We'll take their questions, and I'll continue with my questions afterwards. So Vinay, you can go with your question, unmute and ask your question to sir.
Hello.
Yeah,
Hello.
Vinay,
Yeah,
go
we
ahead.
can hear.
Yeah, sir. Good evening, Nooresh, sir. Thank you for connecting this session, sir. Hello.
Yeah, yeah, go on.
Yeah. Sir, actually, when we look into the technical point of view, sometimes when we look at the daily chart and go for higher frames like weekly, monthly chart, there is a diversion of the views, sir. For example, the daily chart might give you a buy signal with all the two or three indicators like momentum indicators, I mean volatility indicator and a strength indicator and all, but the monthly and weekly chart does not give like that, sir. So sometimes what happens is our decision goes right and the other time it goes very badly wrong. So what might be the reason for like that?
So this is where I have a logical problem. So I am someone who looks at daily charts, and the daily chart can be looked at a time frame of 10 years also, right? The price data remains the same. When you go to weekly or monthly, it just reduces the number of data points, but the data remains the same. A 52-week high will also be a 1 year high, right? So on a 12-month chart also, it will be a high. So the problem is if you start using indicators only, then you'll have a problem. If pure price patterns are there, if a stock is a 5 year high, it will be a breakout on daily charts, it will be a breakout on weekly charts, it will be a breakout on monthly charts. So the fact is, if you do not like a stock on a 6 month time frame, it is very difficult to like it on a 5 year time frame as well, most of the times. So my view is you start off with a daily time frame, but the problem is people look at a daily chart for say 4 weeks and then they say that's it. You look at a time frame of 6 to 12 months on the chart, then it becomes easier. So then you go for a 3 year, 5 year time frame. So your number of years of data which you look at is actually your time frame, not the weekly chart or the monthly candles. If you're looking at 4 monthly candles, it does not make it a monthly chart as such. So the view is if you look at longer term breakouts, it will definitely be a breakout on the daily chart as well. So if you are looking at for longer term breakouts, say if you're looking at a 6 month trade, you need to look at a 3 year chart. So a very simple calculation which I have is say if I say if I want to own say a trade for 1 to 3 months, right? I need to look at 5x the data. So if it is 3 months, you have to look at least 12 to 18 months of data. If you're looking at a 1 year holding period, you have to look at 5 years of data. So the number of data points is the critical factor, not just the weekly or the monthly charts. Because if you look at a weekly chart for just for 3 months, the your interpretations will be wrong only.
Okay, okay. Thank you, sir. Sir, one more question, sir. Suppose, for example, a stock is in a sideways phase, sir. It is not in the uptrend or downtrend. in all the time frames, I mean daily, monthly and weekly. So how do we know that whether it is a accumulation, whether it is an accumulation phase or distribution phase, wherein sometimes the big players slowly accumulate it and it will break out after some 3 months or 6 months. Sometimes it might be a distribution and it might break down as well. So how do we know during the sideways phase whether it is a stock is in an accumulation phase or distribution phase?
So this is where there is always generally a confusion in terms of accumulation and distribution, right? But if a stock is down 50% from the top, it is difficult for the chances of it being distribution are much more lesser. Same way, if a stock after going up 3x is going sideways for a period of time, it could be accumulation for the next trend. So preceding trends are a very important part, not just the current consolidation. So if the current consolidation is 3 6 months, look at what has happened in the last 1 2 3 4 years. That will give you a good indication. And if you're in doubt, you don't need to act right away. You need to wait for price to confirm, right? So you can wait out for prices and volumes to confirm. So you'll see volume patterns also. Ideally, in a distribution pattern or an accumulation pattern, you'll see volumes also picking up in the later part of the breakout most of the times. So when you're closer to the breakout points, generally the volumes increase by some margin. So you start looking at both the patterns. If you think it is accumulation, distribution, if you are confused, wait for price action to confirm.
Right. Thank you, Vinay, for your question. So, Nuresh sir, like when it comes to portfolio building, so how many stocks do you keep in the portfolio or in your approach? And what about the position sizing of individual picks?
My view is a normal individual cannot remember more than 50 stocks. So I did this exercise whenever somebody comes, when we come something for a training program or etc. If I were to tell me the Nifty 50 names, you'll not be able to tell it to me, even though if you're a full day Nifty trader. Same way you have a portfolio of 60 stocks, you'll end up saying 55 or 65. So that's the over diversification period. You can have a lot of tail positions, 0.5% of the portfolio, etc. for tracking. But the core portfolio generally is between 12 to 25 is a good number. And say anything below 1% allocation to a stock just does not move the needle, right? A 0.5% allocation needs to go up 10x to really make an impact, or at least 3x, 5x to make an impact on the alpha. So the minimum, there are two strategies which we generally run. One is a top 10 wherein 10 equally weighted, or otherwise it is something like where we go 15 stocks, roughly 12 to 15 stocks, 4% is a minimum weight, 8% is the maximum weight. So in that case, if we are at 4% all, then we'll have a maximum of 25 stocks, or you'll have somewhere between 12 to 25 in that case if you have the full 8% into all stocks. But anything beyond 25 names is difficult to remember. You can have a tracking list beyond 25, but a portfolio beyond 25 is difficult to track. Somebody who's regular and full time may be able to track 25 to 50. Beyond 50 is something which is very difficult for people to remember. So the view is you need to find your say comfort between 10 to 50 stocks. I know there can, so I have a personally very high allocation to a single stock, but that is my capacity to take risk. For a normal person, beyond 20% into a single stock is difficult. So closer to 4 to 20% is a band where you want to have a single stock exposure. And that is most what people can digest. And what we realized over the years is when we did our analysis, over diversification in the space which we track. So I'm more into mid caps and small caps. Over diversification does not really help because in a down cycle like 2008 or 2013 or 2018 to 20 or 2020, what we realized on the down cycle, there is absolutely no advantage of diversification. Most of the stocks fall equivalent to the index, the small cap index. On the up cycle, the problem is over diversification would actually hurt you because some of the best winners of yours will not have a very large allocation. So it took a long time to realize this, but over the years I've gone closer and closer to a 10 to 15 stock portfolio. Personally, it could be two stocks, also 50% of the portfolio.
Right, right. So we take another question. Bhavesh, you can unmute and ask a question.
Sir, I'm in learning phase, so I don't have many questions.
So kind of you. Thank you. So Mayur, you can unmute and go next. Mayur, are you there? Mr. DW Garg, आप पूछ सकते हैं. Mr. Garg.
सर बिल्कुल I am in the market from last 20 years. I missed the three bull rally and captured this time. So I believe that some of the stocks pay very well, and you can capture more than 25 stocks if you capture rally on the time, large cap, small cap, or mid cap. But
Mr. Garg, do you have any question or like any statement to make? I would request you to stick to question, please.
so if I have 25 stocks in last 20 years from as of now, which I have to keep.
Yeah, I did not exactly get your question.
If I have,
Yes.
investing in keep stock in large cap and mid cap from two Nifty 52 plus 250, which
Hmm.
stock I have to keep myself from next 10 years?
So that is what I say. The next year, 10 years, if somebody could understand a lot of clarity, uh, one would be a big visionary. I am not, and most of the people are not. We try to believe that this is a sector which will do well, but essentially, the fact is markets are dynamic, businesses are dynamic. So, so my viewers don't take a 5 year, 10 year view. A 5 year could be a multiple 1 year views together put together. So it could be 5 year views one by one. So I don't take a 10 year view because a lot of things change, and we've seen that changes happen over the last few years. And that's the simplest view. If you were a visionary, if you could understand 10 years, you would rather run that business rather than buying a business.
Yeah, and exactly like Nuresh, today's topic is investing beyond buy and hold. So Nuresh, like talking about it, so do you think the time has gone where the buy and hold strategy used to work, or there are nuances which we are missing on it?
So the buy and hold can mean buy and hold equities. Buy and hold should not mean hold stocks forever, right? You can have different stocks. So the point is buy and hold. So you can have 100% equity allocation for the next 20 years. So you're still a buy and hold investor. It's not necessary for you to own a stock for 10 years. Uh, there is no, say, there is no compulsion to you to hold a stock for 5 years or 10 years, right? Just to do that. So you can have a technical approach. You can have an approach. So my approach is buy and hold should be I have a very large allocation to equity for a long period of time, but I need not be married to a stock forever, right? Because there are periods of time where stocks go through sideways, zero return period for decades. So Hindustan Unilever between 2002 to 2012 was not a bad company, right? But the 10-year return was zero, only the dividends were there. Reliance Industries from 2010 to 2017 or 2009 to 2017 was a zero return period. Then it goes up 3x. It may cover up for the previous 8, 10 years of lack of returns, but will you have the gumption to hold for that long, right? And beyond 10 years, a lot of people, those who have got lucky, a lot of these comes from the fact that historically, from the 1980s, the 1990s, a lot of stocks have become thousand baggers, hundred baggers, which may not be as easy today because those times were different. The markets were not as well captured. There was a CCI which made it sure that a lot of those IPOs came at face value or very limited values. Today, an IPO market, if you were to, so I know a lot of investors 30 years back, those who only bought IPO stocks and left it forever have made a killing beyond logic. And if you were to do the same thing today, you would get killed. So the fact is, buy and hold means buy and hold equities. Does not mean buy and hold one stock or two stocks or three stocks for 10, 20 years.
Right. And Naresh, like what's your Mayur, I'll come to you after this. What's your view on timing the market? Because although like the thing which you just explained was time in the market, right? And now let's talk about timing the market. So how feasible you think it is, and with the help of technicals, can we broadly like time the market in bigger sense, not exactly the exact bottom or top of the market?
So the problem is theoretically people say timing the market is impossible. The reason is people talk also theoretically and then they think also theoretically. Timing does not mean you buy 100% of your portfolio and sell 100% of your portfolio, right? So the problem is if you try to do that, you'll go wrong multiple times and you'll never get back in. So suppose if you sold in COVID at say 10,000 Nifty and you saw 8,000 Nifty, you sell 100% of your portfolio. If you're not able to buy back at 12,000 Nifty, then you're gone. You're out of the game. But if you can time your portfolio in the sense of going from 10 to 40% cash, somebody could go to 60% cash and time your new entries into the market. So, for example, everybody has cash flows which keep coming in every month or lump sum cash flows from various sources over a period of time. You hold on to those cash flows, wait for the opportune time. Say, for example, 2020 comes in, or for example, even in 2022, there was Russia Ukraine, right? That is the point of time you want to deploy more money. So, timing in the market could be with 10 to 40% of your cash allocations plus another 10 to 40% of your fresh cash which keeps coming in over a period of time to hold on to it in times of exuberance, right? So in 2017 if you held on to your cash for the next 1 year, you saved yourself from the drawdown, and also that cash will allow you to buy new leaders, right? What happens is in every cycle there is a sector which does really well, which may not do well the next time. For example, 2020 to 21, it was all about digitization, pharma. They've done terribly over the last 1 year. So if you would have had hold on to some cash in 2021, on the way up from 2022, instead of buying IT names, you would be buying banking names. So that would be huge outperformance. So my view is try to time the market in terms of 10 to 40% of cash, holding on to the cash. Now, after this, once you've accepted this, then you can start using technicals in the sense that, for example, in November 2020, we were at 12,400 Nifty. We are back to new 52-week highs, new all-time highs. But the mid cap and the small cap indices were still down 25 to 30%. So at that point of time, you could have still bought in new cash, saying the markets have started a new rally, but there is still a lot of opportunity left in the broader markets. So we do this a lot of analysis. I've written a blog article on 24th March 2020 saying equity has never been bad. Everything is priced for extension. So we've been able to time all the markets, but will I time it with 100% of the cash? No. So would I try to time it with 100% of portfolio? No. But can I go to 10 to 40% cash? Huge difference. And remember, worst timings can kill you. So if you bought all your money in 2007, right, for the next 14 years, your returns are beyond, are not able to cross fixed income. So time in the market, how long, right? So I say time in the market is more important than timing the market for AMCs to tell you that, so that you never try to do it. Because if you start doing it, right, the industry cannot sell you the bad stuff in good times. So NFOs in 2007 or ULIPs cannot be sold, right? So that is the whole thing. You have to look at it in terms of being roughly right. So the point is try to be roughly right. Don't try to exactly time the markets, and you can always do it with part of your portfolio.
Right. Point well taken, Nooresh. So Mayur, you can unmute and ask your question.
Hi, sir. Yeah. Good evening, sir.
Yes, sir.
Yes. So, sir, as you already discussed, like we need to buy and hold. So, according to you, what is the emerging sector then that we can invest in, maybe for next couple of years?
So, say I keep talking about sectors. For example, it has been capital goods which has been doing well for the last 1 year. Right now, say I've just written a note also wherein I've looked at which sectors are interesting. There is a recent YouTube video which I've discussed. So, a lot of things related to manufacturing are doing interesting. Then, a lot of hospitality spaces still have say hotels still have a shorter term next leg of the move left. So the point is out here, my view is going forward, new sectors will emerge. The last 1 year sideways of the markets, we saw a few sectors do really well. Capital goods, banking, and various names. We are on the look for new sectors. Right now, we are finding more stock specific opportunities compared to sector opportunities.
Yes, sir. And so one more question regarding the recession, as we can read it out from the like Google and all that they are predicting the recession may come in 2023, and so what's your point of view regarding that?
So recession equal to fall in the markets is the bad behavior which we think. So we
Yes.
just tend to think that recession means a bear market, which is not necessary. So the fact is, markets many a times are 6 months ahead, 12 months ahead. So the recession could already be there. Should be priced in at times. So if you look at it in all the previous cycles, the markets were much ahead of time. And the point is, recession in economic terms should also mean recession for a lot of earnings. So the thing you need to be worried about is not a economic recession, but a recession in earnings. For example, earnings did not catch up in 2015 to 17, even though there was a lot of euphoria. The markets caught up in the next 2 years in some way or the other. So my view is we read a lot of stuff online and we make very quick conclusions. So do not make quick conclusions just because you've read a newspaper article somewhere. Try to look at more deeply into fundamentals or technicals to decide your strategy rather than a news article.
Yes, sir. Thank you very much, sir.
Thank you, Mayur. So, Nuresh, like coming to risk, so how you define risk and how you incorporate that in your investment process so as to be on a safer side in the sense to protect the profits or maybe to limit the downside.
So I have this saying which I've made, which is retail investors lose by only two things: leveraging and averaging. So if you are leveraging a lot, you're bound to fail at some point of time. So the risk can be reduced by reducing your leverage or being non-leveraged. Second is to avoid averaging. When I mean averaging, so we have this tendency, the retail tendency is to get into a lot of names which are sub 100 rupees, but market caps could be very, very large. So the view is avoid leveraging, avoid averaging. That's the first rule. Do not over leverage. Second is, once you've understood this basics, second is control allocations. So control your size. Uh, like I said, you can have a lot of confidence on a company, a lot of confidence, but things could change, right? COVID can come out of nowhere, which is not something in your understanding. So that is the point of time you have to have controlled allocation, right? For example, you have a diversified portfolio. Some of the companies benefited. So FMCG, pharma actually benefited from COVID. IT benefited from COVID. So if you have diversification, at least 10% of your portfolio would be in some part of this. So be a little diversified. Do not over leverage. Do not average a lot. Right. The worst mistakes happen in averaging. You can keep averaging yes bank. It will not become even at any point of time. So the viewers look at this basics. People go a lot more into micro. So people tell me I have this stop losses, etc., etc. But they're 5% of their net worth into equities and spending 60% of their time. Just does not make sense. Right. So the viewers, you look at risk in terms of your whole net worth as well, not just the equity portfolio. If you have an equity portfolio which is very large part of your net worth, then you'll automatically start thinking about risk.
Right. So, Nuresh, these days we see a lot of talks about momentum, right? I mean, and as far as the technical side of your process, so you manually screen the charts, or do you have some system in place with the help of which you find out the names which are showing strength, and on the basis of you make your investment or decide on the investments?
So this is where I've still controlled, still remained a lot more old school things which have worked for me. So we scan stocks on a manual basis. So I may look at 1,000 to 1,500 stocks on a regular basis, which are there on NSE. There was a time where I would used to look at the whole BSE, but now I look at only NSE names. And then I have a list of BSE names, which are only BSE, which are there on radar. And what you keep doing on a daily basis is you may look at 1,500 stocks, right? If out of them 500 stocks are in multiple downtrends, those did not be in your list because you cannot short them. That is the first part. So you cannot profit from it on the downside. Second, you're not interested in it. So, for example, if you were to remove Reliance, Power, Yes Bank, Vakranji, many stocks, out of 1500, your list will already be lower. So what I personally do is a very simple process. I have a list of 1500 all NAC stocks, which I'll keep looking at it regularly. And every day when I sit for it, I'll just right click and add to favorite stocks which look interesting. So the interesting list will continue to grow, which anyways I would not miss it on a daily basis. People try to look at screeners, but the point is a lot of screeners will not scream after say the momentum has already taken place. So you create a screener for contraction pattern, you get a breakout, right? Then after 5 days, the your screener is not going to scream about it. But the fact is that contraction is for 2 years, so it will play out over the next 6 months. But after the first 10% move, your screener will not work on it. So, and most of the times, my process is to try to preempt breakouts, wherein we are already ready. Okay, this is a potential breakout which is going to happen, wherein we try to look out for already consolidation patterns. So, if you were to preempt, then you cannot use screeners. So my strategy is to preempt, make a pre-thesis on a lot of sectors and stocks. Okay, this is a possibility which could happen. So in that case, you have to track manually. Yeah.
Right. And Naresh, like when it comes to selling your positions, so selling is the most difficult part as far as like if you were to ask me personally, also like most of the people I have hosted, they also saw the toughest part in investing is selling. So how you maintain the sell discipline and what exactly processes which you follow and decide on the basis of that, yes, I'll sell at this time, or maybe what exactly is your sell strategy?
So selling has a lot of thought process if you have a very concentrated portfolio. If you are equal weighted, there are two choices all the time. See, one is you exit because price action has gone wrong. You've got stopped out. Now that's a discipline you follow, which is where all your reasons have gone out. Say maybe a time stop loss has taken place. So the first reason for exit is which is your pre-decided, which is on stop losses, time stop losses, things not playing out, view changing, etc. The second one is relative choice. Now this is where the major problems happen because what happens is many a times there is a good possibility that a new sector is emerging which looks much more better what you're holding, right? That's the time you need to make a choice. And that is where a lot of alpha comes in. Say, for example, you get a choice in 2022 to buy banks, which were taking leadership. Right. In 2020, it is IT. So you need to exit out of stocks which you're owning before that to get into new ones. So that is the strategy. And the final one is you decide the market view, right? Where the market is overdone. This is where I use, I've been talking about this multiple times, which is looking at the BSE small cap and the Nifty. Whenever BSE small cap is making higher tops and Nifty is making lower tops, that is the time I get scared. And that's the toughest time where you just want to keep on increasing cash. So this is one criteria we've been using BSE small cap by Nifty. BSE small cap can have any number of stocks. It is always tracking the bottom 15% of the market cap, unlike all other indices which are always on the top side of it. Nifty 50, Nifty small 100, Nifty small cap 250, etc. This is the bottom 15%. So whenever this index starts outperforming the Nifty, you get scared. Till the time it is in line or underperforming, you don't care. But that is the time where you're actually selling early. So that's the main thing. So one thing which I have a rule basically whenever BSE small cap starts diverging with the Nifty, you're not going to put any new money into the markets. Start increasing cash. So that's the main tool which we use for selling in terms of the portfolio level. Because like I said, you can be buy and hold across equities. No. So you may sell X stock and buy Y stock. But what is the time when you want to remove cash? When BSE small cap outperforms Nifty by a margin.
Right. And Nuresh, like there is always an opportunity cost of keeping cash for long. So there are market times or we in periods in the market where like you do not find too much or too many opportunities. So in such situation, how you manage your behavior, or you differ from this, that there are always opportunities in the market, whatever the situation.
So, if you're an extreme short-term trader, cash is also a position, right? Because that allows you to find a new trade which comes out of nowhere. So, if you're trading on a time frame of 5 days, 7 days, 20 days, right? You need to have open positions because something will break out, and if you don't have the cash at that point of time, you'll miss out on that opportunity. You go a little longer term, uh, higher cash is a problem. Sitting on 40% cash and the market rallies up 50%, you've lost all the opportunity, right? So the viewers, you do not take a cash call easily. So I recently did this, uh, uh, say a 2 hour video, 1.5 hour video on what are the types of corrections. I'll quickly summarize. 40 to 60% fall like 2008, right? There will be a preceding bull market, which is where you'll get some indications that you need to pull out some cash. If you don't, you just need to sit down with not putting new cash. That's the point of time where you will be hit. Even if you sit on 20% cash, you cannot stop it. The second is the time wise correction market, which is 2000 to 2003, 2010 to 2013, grueling periods of time where the market falls 50%. The small cap index, right? Even though the index does not fall as much, this is the period of time a little bit of cash will help you, because you keep that cash on so that you get into new leadership. And the third market is something like what happened in 2021 to 2023. Even though the markets are flat, you could make a 20 to 40% return. That's the point of time you don't want to hold cash. So you make a point that you try to realize, are we getting into that sort of risk? So for a simple example, today is not the point of time I want to keep a lot of cash. I want to be fully invested. But if you were to ask me in 2021 end, I would say fresh money needs to be careful. Say today we are at this point, if we are 30, 40, 50% higher over the next 1 year, then maybe the view will change. So you have to make yourself a thumb rule. This is the period of time where I want to stop investing new money. This is the period of time where I want to increase cash. So for example, we have a ratio called BSE small cap by the Nifty. When it goes to the upper band, we look at increasing cash or not deploying fresh money. Closer to one, you want to be deploying money. So you need to create your thumb rules, because otherwise, if you've not decided, you are going to take a decision of going on to cash because you read about recession in the US. You read about Russia, Ukraine, and it could stop everything in the world, right? So the viewers create a process wherein this is the period of time where you want to be on cash. This is the period of, and essentially, if you cannot do all this, remain invested across cycles. Try to time it with your existing new money which you put into the markets, which you put only when there is a drawdown.
Nuresh, I think I lost you. I cannot hear you.
Uh,
Okay, yeah,
can you
right
hear me?
now. Yeah, right now I can.
All right.
So Nuresh, like when it comes to the happenings across the globe, and tracking the macros and the trends which are ongoing in the market, so how easy or difficult it is, and how much of what we say place does they find in your investing process? How important do you think tracking macros is there?
So my belief is over understanding of macros can actually kill you from making a good return. Go back to 2006, the first time people started talking about subprime issues in the US. And the best possible equity return you could have made in any year was between 2006 mid to 2007 end, right? 2017 demonetization happened, and you also had uh, the US election event. 2017 was the only year where none of the markets across the globe fell by more than 8% from the top to bottom, right? 2014 Indian elections, you could have understood what could happen with elections, etc., and not take a call, and you would miss out on the biggest rally. Same way in 2020, you by the time you come to March 2020, you understand things will go haywire, etc. The markets have already bottomed. So my view is understanding macros is very different from making that conclusion towards what will the market do. So my view is I look at macros in terms of what are the markets across the world doing. So if I were to look at various indices, then look at some structural points like dollar index, various things. So I would rather look at data rather than macros, because your macro understanding will not allow you to make a solid return, because you might be the smartest guy in the world saying 2 years out there is a recession, but in that 2 years the index could go up 100%, so you lose it all. So I prefer to look at macros from the picture of technical. So my view is I'll take a global technical chart picture rather than take a macro picture.
Although the similar question was asked by our attendees and you somewhat answered, but again, let me ask any interesting sectors or investment pockets which you find interesting going forward from here with a view of say 1 or 1.5 year, maybe 2 years maximum. So any view on that? Any sectors coming to your radar?
Say one sector which we've continued to hold on is capital goods, anything related to manufacturing and building. So it could even be capital good companies in transformer, or it could be a company which is making pipes, right? So the whole gamut of manufacturing comes into it. Second is hospitality, hotels, which we continue to own some of them, which looks like interesting trade for the near term. But given that it's a cyclical sector, we are ready to switch views if the trends change. And the next is, say, something like in defense, there are a couple of pockets which look interesting. So apart from that, it is more stock specific in nature now. For example, if you look at a classical example right now is IT stocks. There are a couple of stocks setting 52-week lows, couple of stocks setting 52-week highs, which tells you it's not a sectoral move across the board. So as of now, we have more stock specific approach compared to what we had in 2021-22. In 2023, it is more stock specific rather than sector specific.
Right, fair enough. Uh, One more. Yeah, you were talking about averaging. So when it comes to position sizing, so is it like one-time lump sum position in any company, or you also do upward averaging as and when situation demands? How exactly you go about it?
So most of the times there are two ways you size a position. One is many a times it's a very tracking position. So for example, a stock is on radar, say multiple times the stock has say not been able to cross 400. The stock is in a range of 350 to 400 for quite some time. So you take up a tracking position. Say maybe you are going to buy 100 shares and you buy 5-10 shares to just keep it on the tracking radar. But once your breakout is in, you want to be 100 right away. So I don't want to be averaging up if I'm confident. Then second is on the way up, you've bought at 400, at 450, it could be another 100 shares, which could be double the size, right? So the view is if you are convinced the breakout has taken place, then you go all in right away, whichever is your allocation. So I don't go into a process of averaging just for the heck of averaging. So on the way up, we'll keep on averaging, maybe increase allocation. Something could be a 4% allocation, will become a 8% allocation. But you don't want a 1% allocation all the time. So I have this strategy wherein it would be 4% to start with if I'm not very confident. And if I'm confident, I'll directly start with 8% allocation in the strategy. So the view is you can keep adding on the way up. On the way down, you have to be very confident. So the only time we do averaging on the downside is if we have a fundamental bias. On technical bias, it's very difficult to actually average a stock 10, 15, 20% lower.
So any instances to your mind where you think technicals have limitation and they fail on the idea with which we think on the investment?
So the premise that technicals is everything is the where we have our failures. We tend to think everything is in the price. It is not in the price. The point is, if you have a technical bias, you should think you are dumb and you're a follower, right? But the problem is people who look at technicals tend to think they're superior, which is absolute stupidity, right? Because we are not uh, trend creators. We are not buying 5% of equity and moving the companies, right? So I remember a statement by one of the fund managers when somebody asked him on technicals. So he said, I make the chart by buying 5% of equity, right? So the point is we are dumb followers. So we are accepting that we'll go wrong multiple times. We are not going to get a hit rate. So The biggest premise is that you accept the fact that you'll be wrong more often than not. But when you go right, you'll make a killing. So technicals is not everything. Everything is not in the price, right? The market does not know everything at every point of time. We say bhav bhagwan che, but the fact is bhav is moving every day. So you have to move according to the trend. So the viewers technicals has its limitations in terms of understanding the longer term trends many a times, right? Because many a times the stock will go from 100 to 1000 rupees, but you'll be out once the stock falls from 300 to 180 rupees. So that's a problem which you'll face on technicals, and then you'll never get back in. So the fact is, technicals will not allow you to ride big unless you have some sort of a say equity optimism. So my view is technicals or fundamentals, everything is just another tool to allow you to make better returns than the uh, benchmark indices. So try to use it with simplicity, accept the fact that you will be more wrong than you think. So don't think you're a smarter guy just because you know technicals. Accept the fact you're dumb and you're following the smarter people. So I have this saying, somebody, either the company or the people who understand the company, are taking a large bet. That's why the volumes are increasing. That's why the price action is. And that's the reason we are going in. We are just following the smarter people. So we are dumb people following smarter people.
So another question is like Nuresh, how you keep your emotions and maybe control your behavior when it comes to investment, because that is the toughest part. I think we get swayed by, and we even if we have years of experience in market, we still have our biases with us. So how had been your experience and how you overcame that?
So the fact is, you will learn with time. Time is the biggest learning in the market. So you're a learner all through your periods of time. So the first cycle you'll make one mistake, second cycle you'll make one mistake, third cycle you'll make one mistake. The fact is, if you do not make the same mistakes and again, you'll prosper. So my view is, emotionally, it is difficult to be right all the time, and you will get setbacks in the market. So accept the fact that you're not superior. Say the time you think. So the reason you want to be humble is because market loves to humiliate all of us. So my view is very simple: stay humble, accept the fact you'll go wrong, and even if you have spent 30 years in the markets, 40 years, 20 years, like there is a saying, because of the numbers of years spent in the markets, at times it can become more difficult to accept new things because we have a lot of biases in terms of companies, sectors, etc. And things change. So the viewers, if you keep yourself humble, if you keep yourself not thinking just because you've made money or you've made returns or you've made a killing in the markets to think you're superior. If you stop thinking of yourself to be a superior fellow, the markets will be very kind to you.
I agree, totally agree with this. So Nuresh, like we all make mistakes in our journey. So any two three mistakes to your mind which you can tell to our attendees, because learning from others' mistake is also a great learning in the market.
So I've made multiple mistakes over the years, some of them near fatal. In 2008, I remember getting into a single stock portfolio in derivatives because I met someone who was on the board of the company and got influenced and lost a lot of money. So all the returns I made in that 6 months period of time in derivatives, in that 1 year, I lost it in 6 weeks thanks to that trade, that single trade. Then in same way in 2013, I remember I was heavily leveraged. So a 10% fall gave me a much bigger drawdown than I should have taken. So that's the case. So 2008 was the learning that I would rather lose money on my own than to bet on somebody else's view. So that has been the learning, and that is what I've followed as much as possible. You still get influenced a whole lot of time, but you don't get influenced to the point that you have a 100% allocation to a single stock. So you have a respect quota for someone, but it does not become a 100% quota for someone. So you will make mistakes all through. So 2008 single stock took away all the returns of 1 year, and that single trade was a killer. 2013 being leveraged to the point where you could not control your positions, and it was just say 3 days before the bottom where I had to sell because of margin issues. Uh, Then, so over the years, I've always been leveraged, but I've understood the fact leverage implies higher drawdowns. Try to live with it. So, biggest mistake, getting influenced by someone to take a large allocation, taking very large leverage, being overconfident was one of them. So, this were the two major learnings, and I keep making multiple mistakes. It's just that over the years, I've decided not to make fatal mistakes. Wherein, so my mama says no capital markets. So you can lose a large part of capital, but not, so you can lose 30-50% of capital and still come back. But it's very difficult to come after the 80% wipe off.
Right. And I remember like the podcast which you did with Puneet Khurana, you guys hosted at Stoic are just wonderful. That was really helpful for the community. And I would also request our attendees to have a look at that. I'll share it in some time. So I mean, Nuresh, like coming to the question. So who is your investing idol? If I were to ask you in Indian context or maybe outside from India also.
So I will not talk about people who are very well known, but I've learned a lot from investors which I met over the years. So there were a lot of names which people may not know about: Kukuji, Vinod Oriji, Sunil Shah, Neeraj Marathe, Gaurav Sood, Ayush Mittal, multiple sets of people, Bhavesh Bhai. A lot of these investors. See, one thing is to idolize people, those who are stars, right? But you actually learn from people who give you the time. So I've met maybe I've been lucky enough to meet at least 20 to 50 such people. So, for example, there is a interview of one of my mentors, Divyesh Bhai, which I've learned a lot from on Stoic Talks. We are coming with a new edition also soon, so you'll see a lot more podcast of interesting people. So, Divyesh Shah, you will not know about him. So, there are multiple such people which I've learned from, those who have actually spent. So, I remember going into a meeting with them and spending up 3-4 hours non-stop, wherein they kept on giving all their knowledge and their wisdom over the years. So I we can all idealize Rakesh Junjunwala for his guts, etc. But we've not got a personal experience of learning from him. It's all from what he has said and what he has done. But I've been lucky enough post 2009 to meet a lot of investors, spend a lot of time, and I have no shame in asking people to give me a meeting and then sit till the time they allow me to sit. So there are multiple names. If I were to take a list, it would be more than 10-20 people.
That's great. And I remember the video which you just mentioned, and the person is so passionate about reading the annual reports, and that is really, I mean, one of the greatest video you guys did previously. And surely look forward to new session of Stoic Talks, and that is really helpful for everyone around. So Nuresh, like I holistically covered all the questions which I had in mind. Any closing remarks or any good literature or books you would like to suggest to our attendees, which can help them? I mean, maybe an investing one, or maybe apart from investing also.
The three of my favorite books are: one is Reminiscences of a Stock Operator on Jesse Livermore. Second is Bulls, Bears, and Other Beasts by Santosh Nair, gives you a lot of perspective of Indian markets. Third is Capital Returns, which is very interesting, which gives you a lot more on cyclical supply side of it. It needs multiple readings to actually understand the stuff. So these are the three main books which you can read. There are many other books which I've written about, but these are three which are interesting, fun, and easier to read as well. Not very complicated. And I would like to end with the fact that buy and hold is good. Buy and hold equities. It's not necessary to own the same stocks.
Great, many thanks. And Capital Returns and the book by Santosh Nair is awesome. And the first one, surely I look forward to reading to that. And even we had a session with the Sant Nair on his book, and that was indeed great. It's good to understand the Indian markets. So no forward to reading to that. And even we had a session with the Sant Nair on his book, and that was indeed great. It's good to understand the Indian markets. So, Nuresh, thank you so much for your time. It was really insightful, and you take out your time so as to answer our queries and even to questions from
Thank
our
you, Prince.
attendees. Thank you so much, and surely look forward to your interactions in the future as well. keep adding value to everyone around. Thank you so much. And
Thank you.
those who joined late, the session is recorded, and you can surely listen to the session. I'll be uploading it over my YouTube channel that goes by the name of Accidental Investor Friends. So surely you can revisit and pass on to people for their benefit. So thank you, sir. Good night. Take care.
Thanks. Thanks. Good night, everyone.